You're listening to Let's Talk Macro.
Brought to you by Bandhan Mutual Fund.
Hello, lovely people, and welcome to Let's Talk Macro, the podcast on macroeconomics by Bandhan Mutual Fund, where we discuss interesting global and domestic macroeconomic topics and events. We're at the end of the first month of 2026, and it might be a little late. Happy New Year, but I have to wish you anyway. I'm Ahalya, keeping you company, and I've got with me, of course, Sreejith Balasubramanian, economist in the fixed income fund management team, here to take us through this macroeconomic download that we've got lined up for the month. Hi, Sreejith. Welcome and Happy New Year to you.
Ahalya, thank you. Happy New Year to you as well and all our listeners. How's it going?
It's going well, but 2026 is seeming quite like 2025, where we don't know what to expect month on month. So I guess the podcast just becomes that much more relevant for all of us. Today's topic is very interesting. Just to give people some context, India's bond market has been impacted by dynamics on the external account front, as the rupee has been facing depreciation pressures, and on the fiscal front, as government bond supply has been large at a time where demand has been moderate. So in this context, the Union budget for FY 2027 on the 1st of February could provide further clarity on the fiscal front. So in today's episode, we're going to discuss the latest fiscal numbers and the key elements to look out for in the budget as the new debt to GDP framework gets adopted. So Sreejith, let's start with the latest numbers, I guess. We spoke about this a couple of months ago, but give us an update on the central government's latest revenue and expenditure numbers.
Okay, so for the data that we have, which is during April to November, income tax has grown around 7% year on year. And this is partly because of the income tax cuts which came into effect from April. But refunds have also been slower this time. Central GST collection has grown over 5% as, again, rates were cut from September. Corporate tax has also grown by around 8%. So therefore, overall gross tax revenue has grown only by around 3% year on year. And again, given tax sharing to states have been front-loaded this time, the net tax revenue has actually fallen by 3% year on year. Now, the good part here is that the non-tax revenue has been higher. So that is due to higher RBI dividends this year. And at the same time, expenditure has grown again by around 7% year on year, with capital expenditure growth being much higher. This leaves the government in a situation where tax revenue could fall short of the FY 26 budgeted numbers, but this should be offset by the higher RBI dividend and the likely lower expenditure. So the market does not really expect any fiscal slippage from the budgeted numbers for FY 26, which is for the headline deficit is around 4.4% of GDP.
Got it. Okay, so no fiscal slippage expected this year despite some revenue shortfall. For the next fiscal year, FY 27, what are the key elements or numbers that you would urge people to look at? Take us through that.
So first thing, the FY 27 budget will be presented based on the current GDP series. Now we know the new series is coming up and that is getting updated for base year, data sources and even the methodology. But that will be released at the end of February, which is after the budget. And therefore that will subsequently be used once we have the new data. So we must see how this change, particularly the wider adoption of the so-called double deflation methodology in the new GDP series, impacts the headline nominal GDP growth number. But that said, the nominal GDP growth itself is estimated to grow 8% this year, according to the official estimates, after 9.8% in FY25. Now that should rebound to say around 10%, as both the WPI and CPI, which is the wholesale and consumer price index inflation, they should actually mean revert from the current low levels that we are seeing. So the nominal growth number is the first thing that we would look at. Second, the implicit tax buoyancy will be important. So the tax revenue growth with respect to the nominal growth. As we just discussed, tax collection so far this year has been moderate due to income and GST cuts both. Though pickup expected therefore in the next year, what the numbers the government estimates for FY27 will therefore be interesting. And again on the tax front, the recommendations of the 16th Finance Commission, that will be out. Again, should be either along with the budget in early February. And that will decide on the tax sharing in grants for states. And that is applicable for the next 5 years. And so therefore that will also be tabled in the parliament. Now this is important because it will impact the net tax revenue for the center, right? And even states, SDL market borrowing, because it provides clarity on future tax sharing and therefore receipts for states. So that will be an additional monitorable this year. And the third variable is, of course, the RBI dividend.
Right.
Now, again, last year was a large number. So in May 2025, we saw the RBI dividend was around 2.7 trillion rupees. And that could even be higher this time, again, when we get the numbers in May. And we'll have to see what the government budgets. Because the RBI has been doing FX sales, so that is US dollar sales, right, to arrest the depreciation pressure on the rupee. And that sort of results in profit booking versus the acquisition cost of the dollar. So a higher RBI dividend is, in fact, possible even after the RBI maintains the so-called contingent risk buffer at the upper end of the range, which is where it is currently. And therefore, we should still have a higher RBI dividend, most likely.
Okay. And anything specific on the expenditure side? We have been hearing about the pay commission impact as well. So what's happening there that we need to look out for?
Expenditure this year could end lower, like I said, than budgeted. But the broad momentum on capital expenditure, be through the center or through the interest-free loans that center gives to states, that is expected to continue into next year as well. Mm-hmm. Now, the 8th Central Pay Commission that you just mentioned, the terms of reference for that was approved by the Cabinet in October. And the Commission is slated to give its recommendations, and this will be implemented, but only after FY27. I mean, the implementation after the recommendation happens, that will be later, but it will have to pay arrears because the impact is technically from this month, January 2026. So while budgeting for this year, the government will definitely have to keep in mind, the impact later on fiscal deficit and debt from the Pay Commission.
So the Pay Commission impact comes later, but with arrears. Given your expectations on revenue and expenditure, what is your fiscal deficit estimate for the upcoming financial year, Sreejith?
So again, first of all, the new fiscal framework with debt to GDP as the anchor will be adopted from FY27. And we've discussed this before, but I'm just repeating the stated endeavor of the framework, which is to keep the fiscal deficit each year such that the central government debt to GDP is on a declining path to around 50 plus or minus 1% by FY31, which is the end of the 5-year period. Now, the reason this framework is being adopted is that it offers the flexibility to the government versus targeting rigid fiscal deficits each year, and therefore it helps the government rebuild fiscal buffers, be it to support growth or respond to some unforeseen developments. And in a sense, it is also more holistic because you're targeting the debt, which is what ultimately matters, versus targeting fiscal deficit each year. And again, it's also transparent. It gives the visibility for the market as to what the government plans to do with overall debt. What is a glide path, therefore, in the next 5 years? And hopefully the budget gives more details on that 5-year fiscal trajectory. So the question in today's context is whether the government should consolidate the fiscal deficit further from 4.4% this year. Now, should it consolidate? Whether it should be flat, or should it respond to external headwinds to growth by, let's say, increasing the fiscal deficit a little? And in fact, any of these can be done while still being fully committed to the new framework. And I think that's very important to realize. In fact, we did some work around this. And what we understood is that the government could, say, for example, choose a higher deficit initially in case, there is a need to respond to sort of any growth worries, let's say, from the external front and so on. And then it can consolidate faster after that, right? So, or for example, it could choose to consolidate in a very steady fashion over the next 5 years. In either case, I think the important point here is that the total fiscal deficit and net GSEC borrowing during the 5 years are very similar in both cases. So it's important again to recognize this flexibility, I would say, and I'll have to stress this more. In sense, there's a flexibility that the 5-year debt-based framework offers is therefore very important. Therefore, the government could even consider a fiscal deficit range, say 4.2 to 4.6% of GDP for FY27 after 4.4% this year. And what this range allows is any potential cyclical growth support that the government could offer, which is again quantified and communicated in advance. And all of this will again be within the 5-year glide path. So I don't think that will be a problem. So I think that will be important to realize the flexibility the framework offers.
No, absolutely. And that's so interesting as well because it, allows for us to take a little detour but then get back well on track. It'll be interesting to see the annual details within the 5-year plan. But given all of this, what is your expectation on government borrowing, Sreejith? Because we did say we would talk about that as well.
Yeah, I think it is ultimately what matters for the bond market. So the final borrowing numbers for the next year, the immediate year. So I would say, even apart from borrowing, there are two important factors which impact the funding of the deficit. So we arrive at, let's say, a fiscal deficit number. So the next question, of course, is how is that getting funded? And there are various elements there, borrowing being one of them. But there are a couple of other factors. One, small savings. And small savings collection has been higher this year, even while the budgeted number has been lower than last year. And as we know, the rates on these schemes are administered and they are higher than bank deposit rates. And bank deposit rates are moderated this year with RBI rate cuts. So inflows into these small savings schemes could remain strong into next year as well. So that's one important thing to realize. And the other thing is net T-bill borrowing, which is actually zero this year. And it was in fact negative last year. So some borrowing in FY27 could therefore be shifted from GSEC to T-bills, especially, and I know we've spoken about this before, because the average maturity of GSEC issuance has risen and the risk appetite across the GSEC curve has been quite moderate. So there could be a case for shifting some borrowing from GSEC to T-bills. And if you look at the share of fiscal deficit that is being funded through net GSEC borrowing, it is around 72.9%, roughly 73% in this year, that is FY26. And even if we assume a lower share, therefore, because in case some funding of the fiscal deficit through small savings and T-bills go up, the gross supply of GSEC and even SDLs together is still likely to rise quite meaningfully. I think that's the important part to note here. Because if you look at the numbers, the gross GSEC borrowing can be above around 17 trillion in FY27. After 14.7 this year, while the net borrowing number can be around, let's say, 11.5 to 12 trillion, as redemptions are much higher next year for GSEC. And state borrowings, like I said, through SDLs will add to this. So the total GSEC plus SDLs supply can be closer to 30 trillion on a gross basis and 20 trillion plus on a net basis, and just to give you some broad numbers. But the key point, like I said, is that this supply number is quite a big rise from this year.
Okay, so from that, I understand that other funding avenues could absorb a higher share of the deficit, but bond supply next year should still rise meaningfully, which is something for us to keep an eye out for. With that, it's time for me to summarize the key takeaways. First point of note, tax revenue growth this year has been moderate, also due to income tax and GST rate cuts, but a higher RBI dividend and lower expenditure should land fiscal deficit at the budgeted 4.4% of GDP. The second thing to keep in mind, in the financial year 27 budget, nominal growth and tax buoyancy estimates will be important, while RBI dividend should be higher. Focus on capital expenditure should also continue, while the 8th Central Pay Commission effect will happen later, but with arrears. The headline fiscal deficit could be even given as a range, say 4.2% to 4.6% of GDP, which will allow growth support that is quantified and communicated beforehand. Most importantly, the new debt to GDP based framework will provide flexibility to support growth while being fully committed to the 5-year glide path. That said, in financial year 2027, although small savings and net T-bill borrowing could fund a larger share of the fiscal deficit, gross bond supply is still expected to rise materially. That's it for today. I hope that this discussion was useful and we've got you back on your macroeconomic track for the year 2026. Thank you, Sreejith, and I'm so excited for everything we're going to bring our listeners this year as well. We'll be back with another episode of Let's Talk Macro next month. Until then, bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.